Hello and welcome students. In the last video lecture I had explained you the illustration number 2 of chapter number 5, that is accounting equation and business transactions. Now in this video lecture I am going to explain you the one practical sum from exercise that is on page number 125 of your textbook. Students, this is only one sum, there is only one sum in your exercise. So let's start with the practical solution of that sum. Let us read the question first of all. Question number 2. Write journal entries for the following transactions and explain accounting treatments based on equation. In the last video lecture already the format I had explained you how to present this sum in the typical format that has been specified in the illustration. That is serial number, journal entry, debit, credit, what would be the effect of that particular transaction. It means debit effect and credit effect. Then afterwards assets, due to that particular transaction what would be the effect in the assets, capital and liabilities. And one equation also I explained in the last video lecture, that is assets is equal to capital plus liabilities. So at the end of the particular sum you have to verify that the total of assets should be equal to the total of capital and liabilities. Okay, so starting with the first transaction, commenced business with capital of rupees 80,000. It means business has been started and the owner is bringing capital worth rupees 80,000. So first of all the journal entry, that is first serial number, we have written first one, that is cash account debit to capital account credit, that is by rupees 80,000. Students, now I am not explaining you, you are very much familiar now how to write the journal entry because already we have completed chapter number 4, that is journal. Okay. So first journal entry that would come cash account debit to capital account credit, that is 80,000, and always debit and credit amount that would come same. Then afterwards cash account debit, it means cash will increase. What would be the debit effect? That is cash comes in, so cash balance will increase, and together with that capital will also increase. Okay, so first effect, cash is one kind of current asset, so the effect that would be in the assets, and the second effect that would be in capital, so both will be increased. So first of all assets would increase, that is cash balance would increase by rupees 80,000, and capital will also increase by rupees 80,000, and liability there would be nil because there is no effect in liability. Okay, now moving on with the second transaction. Rupees 20,000 deposited with bank and opened account. 20,000 are deposited in bank and we have opened a bank account. So bank is the receiver and that much amount of cash goes out from the business. So the journal entry that would come, that is bank account debit 20,000 to cash account credit, that is 20,000. And due to bank, we are giving the amount, or we are depositing the amount with the bank. So bank is the receiver. So bank balance will increase and that much amount of cash will decrease. Sorry, here it is written increase but it should be decrease. That much amount of cash is decreased in the business. Okay, because we are depositing that much amount in the bank. So bank balance will increase and cash will decrease. Okay, so here you can see previously the cash balance that was 80,000, from that we have deposited in bank, that is 20,000, so 80,000 minus 20,000, remaining that would be balance of cash, that is 60,000. Then afterwards bank balance will increase, cash balance will decrease, but bank balance will increase by rupees 20,000. So ultimately the total on the balance of asset would remain as it is, that is 80,000. Again repeating, previously the cash balance from the last transaction that was 80,000, from that amount deposited in bank, that is 20,000. So cash balance is reduced by rupees 20,000. So remaining balance of cash, that is 60,000. But bank balance will increase by rupees 20,000. Okay, previously there was no any bank balance. Now the bank balance is created by rupees 20,000 by opening the bank account. Okay, so ultimately the total of assets that would be 60 plus 20, that is 80,000. Then afterwards in capital there is no any change, so capital as it is 80,000 from the previous transaction, and liability also nil. Okay, students, don't forget to carry forward the balance of assets, capital and liability from the previous transactions. Next one, that is third transaction. Goods of rupees 40,000 purchased from Himani on credit. We have purchased the goods on credit from Himani. So it is a credit transaction. Journal entry that would come, purchase account debit as goods comes in. So purchase account debit, that is 40,000, to Himani's account credit, that is 40,000, because due to purchase Himani is the giver of the goods to the business or to the owner of the business. So to Himani's account, that is credited. Okay, now due to purchase, stock will increase. Okay, so goods stock will increase, and in future we have not paid this amount to Himani, so liability will increase, debtor will be created, we have to pay that much amount of creditor will be raised, and we have to pay the amount to Himani, so our liability will also be increased. Now we will see, first of all, cash stock is one kind of asset, so one effect that would be in assets, and the another that would be the effect in liability, because liability is increased. In future we have to pay that much amount to Himani. Okay, so cash balance previously it was 60,000, here also as it is 60,000. Then afterwards bank balance, that was 20,000, same, that is 20,000. And now stock, that has been increased because due to purchase of goods, stock in the firm has been increased by rupees 40,000. So 60 plus 20, 80, 80 plus 40, that would be 1,20,000. So the total balance of assets, that would be 1,20,000. Then afterwards for capital, that is 80,000. And now the liability, that is rupees, previously it was nil, but now due to Himani's liability, we have to pay rupees 40,000 to Himani in future. So our liability is raised by rupees 40,000. Okay. Now after completion of the third transaction, fourth transaction, goods of rupees 30,000 purchased for cash. Now in the previous transaction it was a credit transaction. Over here the goods are purchased for cash. So the journal entry, that would be purchase account debit 30,000 to cash account credit, that is rupees 30,000. Now due to purchase, whether it is credit or cash transaction, in both the goods stock will be raised. So first effect, that would be stock will increase, and second one, here cash payment has been done, so cash will go out from the business, so cash will decrease. Over here also by mistake it is written increase, it should be cash decrease. Okay, due to purchase the cash will decrease. Okay, so stock will increase and cash will decrease. Both this effect that would come on the assets. Okay, so cash will decrease. So previously the balance of cash from the previous transaction, that was 60,000. From 60,000 due to purchase, the balance has been reduced from 60,000 minus 30,000. Remaining balance of cash, that would be 30,000. Then afterwards bank balance, as it is 20,000. Stock, previously it was 40,000 due to purchase. Now again the goods are purchased on cash worth rupees 30,000. So 40,000 plus 30,000, total value of stock, that would come to 70,000. So in this way the total of assets, that is 30 plus 20, 50, 50 plus 70, that would be 1,20,000. Okay, so the balance of assets, that would come to 1,20,000. Then afterwards capital, as it is 80,000, liability also as it is 40,000 from the previous transactions, because these two effects are both in the assets. Okay, so both the effects, one effect in cash and the other effect in stock, both the effects that are in only assets. So no any change in capital and liabilities. So we have completed fourth one. Now moving on to fifth transaction. Goods of rupees 35,000 sold for rupees 55,000 to Jocelyn on credit. Goods of rupees 35,000 that are sold for rupees 55,000. So at a profit we have sold the goods to Jocelyn on credit. So it is a credit sales. Okay. So the entry, that would be Jocelyn's account debit, because she is the receiver of the goods. So Jocelyn account debit, that is 55,000. At which price we have sold the goods? That is at rupees 55,000. To sales account credit, that is 55,000. We have sold the goods, so goods will go out from the firm. So dues will increase because we have sold the goods to Jocelyn, so we on credit. So in future we'll receive that much amount from Jocelyn. So our debtors will increase or our dues will increase. And the second amount, that is stock, will also increase. Okay. So first of all, stock will also decrease. Sorry, due to sales, stock will decrease. Okay, so to sales account, that will be because goods goes out from the firm, so stock will decrease. So first effect, that is cash. The previous balance of cash, that was 30,000, as it is 30,000. Then afterwards bank balance, that is 20,000, as it is bank balance from the previous transaction, that is 20,000. Then after stock value, that was 70,000 in the previous transaction. From 70,000 goods that are sold worth rupees 35,000. Now students, we have sold the goods of rupees 35,000 at rupees 55. It means actually the worth of that goods was only rupees 35,000, but we have sold at a price of 55,000. So actually the stock will reduce by only rupees 35,000. Whatever the extra price we have sold the goods, that would be the amount of profit, okay, and that will be added in capital. Okay, so here we'll deduct only the actual price of that stock of goods, that is by rupees 35,000. 70 minus 35, remaining balance of stock, that would be 35,000. Then afterwards debtors, that would be raised because in future that much amount that will be received from that particular debtor. So debtors price amount will be increased by rupees 55,000 because that much amount will receive from Jaslin. Jaslin is, we have sold the goods on credit to Jaslin. So in future debtor, that is Jaslin, we have to receive amount that is rupees 55,000. Okay, so now doing the total of assets, 30 plus 20, 50, 50 plus 35, that would be 85, and 85 plus 55, it would come to 1,40,000. Now in case of capital, previous balance of capital, that was 80,000. Out of that plus profit that I have done. Now profit how came? Actually the goods that were worth rupees 35,000, that we have sold at rupees 55,000. Okay, so we have sold the goods at a profit of rupees 20,000. How that 20,000 came? That is 55,000 minus 35,000. So difference amount that comes to profit, that is 20,000. So that profit, due to that profit, ultimately the capital of the firm will be raised. So 80,000, that was the previous balance of capital, plus profit, that is 20,000. So the total balance of capital that came to 1 lakh. In liability as it is, there will be no any change, that is 40,000. Okay. After completion of the fifth transaction, moving on to the sixth one. Goods of rupees 10,000 sold for rupees 18,000 in cash. This transaction is a cash transaction. Previously it was a credit transaction. Over here it is a cash transaction. Goods of rupees 10,000. Actually the goods that were worth rupees 10,000 that are sold at a profit of 8,000, and at 18,000 the goods are sold. Okay. So we have received the amount in cash because the goods are sold on cash. So cash account debit, that is 18,000, to sales account credit, that is 18,000. Okay. Now due to goods sold on cash, so cash balance will be increased. Okay, in effect, and due to selling of the goods, stock will go out from the firm, so stock will decrease. Okay. Now the effect in the assets, both this effect, cash and stock, that would come in assets only. There would be no any effect in capital and liabilities. Okay. So cash will increase. Previously the cash balance, that was 30,000. Now in 30,000 we have received the cash due to sales, that is 18,000. So 30,000 plus 18,000, total of cash, that would come to 48,000. Then afterwards bank, there will be no any effect, so as it is 20,000. Then afterwards stock, previously the balance of stock, that was 35,000. Now from 35,000 we'll subtract, that is 10,000, because the goods value, that was 10,000. Actually the value of stock, that was only rupees 10,000, that we had sold for rupees 18,000. So actual value of stock will subtract over here, that is 10,000. So 35,000 minus 10,000, the balance of stock, that would come to 25,000. And the last one, that is debtors, as it is from the previous transaction, that is 55,000. So the total of assets, that is 48,000 plus 20,000 plus 25,000 and plus 55,000, that would come to 1,48,000. That is the total balance of asset. Now in case of capital, the previous balance of capital, that was 1 lakh. Now here also profit, the goods are sold at a profit of rupees 8,000. Actual value of the goods, that was 10,000, and it has been sold at rupees 18,000. So the profit is occurred of rupees 8,000. So 1 lakh plus profit, that is 8,000. So the total balance of capital, that would come to 1,08,000, and liability would remain as it is from the previous transaction, that is 40,000. So students, up till now we have completed, that are 6 transactions. Now moving on to 7th transaction. Let us read 7th transaction. Goods of rupees 2,000 returned to Himani. Previously we had purchased the goods worth rupees 40,000 from Himani. Now out of that 40,000 we are returning goods worth rupees 2,000 to Himani. So it would be purchase return. Purchase return will always have a credit balance. So the journal entry that would be Himani is the receiver of that goods. So Himani's account debit, that is 2,000, to purchase return account credit, that is 2,000. Now what would be the effect of it? That is, due to Himani would be the receiver of that goods, so our debts would decrease by rupees 2,000 and stock will also decrease by rupees 2,000, because previously that goods came in the firm. Now we are returning back to Himani. Okay, so stock will also decrease. So you can see both the effect that would come in the assets only. First one, that is cash balance in the last transaction, that was 48,000 as it is. Then afterwards bank calls balance was rupees 20,000. Stock that was previously 25,000. In that, stock is decreased by rupees 2,000. So 25,000 minus 2,000, remaining balance of stock, that would come to 23,000. Debtors, that is 55,000 as it is from the last transaction. So the debtors, that is also 55,000. So the total value of the assets, that would come to 1,46,000. Now in case of capital, there would be no any change. So as per the last transaction, from the sixth transaction, as it is the balance, that would be 1,08,000. In case of liability, previously the liability, that was 40,000. Now we are returning back the goods to Himani. So our debt will decrease, our debts will decrease by rupees 2,000. So liability will decrease by rupees 2,000. So 40,000 minus decrease in liability, that is 2,000. So remaining liability balance, that would be only rupees 38,000. Now after completing seventh one, let us move on with the eighth transaction. Goods of rupees 4,000 returned by Jocelyn. Returned by Jocelyn, it means we have sold the goods to Jocelyn worth rupees 35,000 at 55,000. Out of that 55,000, she is returning back worth rupees 4,000 to us. So previously we had sold the goods, now she is returning back, so it is sales return. Okay, so sales return account, that would be debited by rupees 4,000, because due to sales return, goods will come back in the firm. Okay, so sales return account debit, that is 4,000, to Jocelyn's account credit, that is 4,000, because she is giver of the goods. So Jocelyn's account will be credited by rupees 4,000. Now due to sales return, stock will increase. Whichever goods we had sold, now they are coming back in the firm. So stock will increase and dues will decrease. Previously we had to pay to Jocelyn, that is 55,000, but now she is returning back goods worth rupees 4,000. So our dues will remain only rupees 51,000. Okay, so both this effect will come in the assets. As you can see, cash balance, that was 48,000 in the previous transaction, as it is 48,000. Bank balance also, as it is from the previous transaction, that is 20,000. Stock value, that was in the previous transaction 23,000, plus stock has increased due to sales return, that is plus 4,000. So the total value of stock, that came to 27,000. Now in case of debtors, the debtors value, that was 55,000. From that, now the dues are decreased, because 4,000 worth of goods are returned by Jocelyn. So now the debtors value will be decreased by rupees 4,000. So 55,000 minus 4,000, the total value of debtors, that would come to 51,000. So the total of assets, that would come to 1,46,000. Now no any effect in capital and liabilities, as it is 1,08,000 and 38,000 from the previous transaction. After completing 8th transaction, moving on to 9th transaction. Accounts are settled with Himani and Jocelyn. Now there are two journal entries we have to write for this transaction. One for Himani and the other one, that is for Jocelyn. From Himani we had purchased the goods worth rupees 40,000. Out of that, goods worth rupees 2,000 were returned back to Himani. So now the balance amount that we have to pay to Himani, that would be only rupees 38,000. Okay, so you can see I have written 9 first one and 9 second one. First one, that would be for Himani, and the second transaction, that is for Jocelyn, to settle their accounts. To settle their accounts means to make the remaining payment to that remaining payment, or to receive the payment from the customer. Okay, so here first of all we are paying to Himani. So Himani is the receiver of that amount. So Himani's account debit, that is 38,000. How that 38,000 came? That is total value of goods, that is 40,000 minus 2,000. So remaining balance that we have to pay, that is 38,000 to Himani. So Himani's account debit, that is 38,000 to cash account credit, that is 38,000. We have paid the amount to Himani. So debt will decrease by rupees 38,000. So liability, one effect that would be in liability, and cash will also decrease because we have made the payment in cash. Okay. So cash effect that would be shown on the asset side. So cash previous balance that was given to you 48,000. From 48,000, 38,000 you have paid to Himani. So the remaining balance of cash that would be 10,000. Now in case of bank, that would be bank balance as it is 20,000. Stock value that would be as it is 27,000, and debtors also as it is, that is 51,000. So the total value of assets that would come to 1,08,000. Okay. Now in case of capital, no any change as it is 1,80,000, 1,80,000. In case of liability, the previous liability that was 38,000. Now that 38,000 we are paying to Himani and settling her account. Okay. So now there would be nil balance of liability. There would be no any liability because whatever the liability that was towards Himani that we have paid. So the liability would be nil. Okay. Now ninth transaction, first one we have completed. Now we are settling the account of Jaslin. Now in case of Jaslin, we have sold the goods for rupees 55,000. So out of 55,000, sales return that was of 4,000. So remaining balance that would be 51,000. 55,000 minus 4,000. Remaining amount that is to be paid to Jaslin, that is 51,000. Okay. So cash will be received, that is 51,000, to Jaslin's account credit, that is 51,000, because previously we had sold the goods worth rupees 50 at price of rupees 55,000. From that 55,000, Jaslin has returned goods worth rupees 4,000 to us, to the owner of the business. So remaining goods that are sold, actually that is only rupees 51,000. So we have to receive the cash, that is rupees 51,000 from Jaslin. So account is settled of Jaslin. So the entry that would come, cash account debit, that is 51,000, to Jaslin account credit, that is 51,000. Now cash will increase because we have received the amount from Jaslin. So cash will increase and dues will decrease. Previously the debtors that was 51,000, now the debtors will become nil because that amount is received from Jaslin. Okay. So both the effect that would come in assets. Cash balance previously it was 10,000. 10,000 plus 51,000, that much amount of cash is received from Jaslin. So 10 plus 51, it would come to cash balance 61,000. In case of bank balance, as it is 20,000, stock also as it is 27,000. Now debtors, previously the balance that was 51,000. 51,000, now the dues will decrease, or the debtors will be decreased by the same amount, that is 51,000, because now Jaslin has made the payment to us. Okay. So 51,000 minus 51,000, debtors would become nil, that is 0. Okay. So the total value or the balance of assets that would come to 1,08,000. Now in case of capital and liability, no any change. So as it is capital 1,08,000, liability that is 0. Okay. So ninth transaction, there will be two effects for settling the account of Himani and Jaslin. Now after completing ninth transaction, let us see the 10th transaction. Withdraw rupees 5,000 from bank. We have withdrawn the money from bank. So bank is the giver and we are receiving the cash. So the journal entry that would come, that is cash account debit 5,000 to bank account credit, that is 5,000. Now cash comes in the business, so cash will increase and bank balance will decrease because our bank balance will be reduced by that much amount, that is 5,000. Okay. So cash will increase and bank balance will decrease. So both this effect of cash and bank will be given in the assets only. Okay. So you can see the cash balance previously it was 61,000. 61,000 plus 5,000. Cash comes in. We are withdrawing that much amount from bank. So cash balance will be increased by rupees 5,000. So the total balance of cash that would come to 66,000. Now bank balance that was 20,000 previously. Okay. Now it is reduced by 5,000. So now the balance of bank that would be only rupees 15,000. For stock as it is, that is 27,000, and debtors already we had paid, that was nil balance. So the total value of assets that would be 1,08,000. In case of capital and liability, no any change. So that would be capital 1,08,000 and liability would be nil, that is 0. So students, up till now we have completed 10th transaction. Now moving on to 11th transaction. that is salary of rupees 4,000 paid by check. So salary is an expense, so the journal entry that would be salary account debit to bank account credit, because salary that we are paying by check, so bank balance will be reduced by rupees 4,000. So the journal entry that would come salary account debit, that is 4,000, to bank account credit, that is rupees 4,000. Now due to salary is payment is made in cash, so in check, so capital will be decreased by that much amount, and also bank balance will decrease. Okay, so the one effect that would be in capital and the other effect that would be in assets. Okay, so you can see cash in the previous transaction, that was 66,000 as it is. Bank balance that was previously 15,000, from that bank balance is reduced to 4,000. So 15,000 minus 4,000, the bank balance would remain 11,000. Then after stock balance as it is 27,000. So the total value of assets that would be 1,04,000. Now in case of capital, that is 1,08,000 from the previous transaction. In that expense, that is salary, is paid, so the capital will be reduced by the amount of expense that is paid. So by rupees 4,000 it will be reduced, so the new balance of capital that would be remaining only rupees 1,04,000. No any change in liability, so as it is 0. Okay, now after completing 11th transaction, let us read 12th transaction. Commission received in cash rupees 3,000 and rupees 2,500 are outstanding. Now one commission that is paid in cash, that is received in cash, another one that is outstanding. Okay, so I have given two different journal entries of the two different transactions. First one, the commission that is received in cash. So cash comes in, so cash account is debited by rupees 3,000 and commission is an income. So to commission account credit, that is 3,000. So as cash comes in, so cash balance will increase, and due to income, capital will increase. As due to expense, capital is decreasing. So due to income, capital will increase. Okay. So here you can see cash balance, previous transaction that was 66,000. Now cash is received, so cash balance is increased by rupees 3,000. So the new balance of cash, that is 69,000. In case of bank balance, as it is 11,000, stock also as it is, that is 27,000. So the total balance of assets that would come to 1,07,000. Now in case of capital, previous balance that was 1,04,000. Now due to commission, the income has been received, so cash is received. So capital will be increased by rupees 3,000. So 1,04,000 plus 3,000, the balance of capital that would come to 1,07,000. And in case of liability, no any change, so as it is 0. Okay, so we have completed one transaction of 12th one. Now outstanding commission, that is rupees 2,500. It means still that commission is not received. It is to be received in future. Okay, so the journal entry for that, that would come outstanding commission account debit, that is 2,500, to commission account credit, that is 2,500, because outstanding commission is a due amount that we have to receive in future. So our dues will increase, and due to commission, our capital will also increase. Okay, so you can see in cash, that was balance 69,000 as it is, bank also as it is 11,000, stock as it is 27,000 from the previous transaction. Now dues that are raised, because in future we have to receive that much amount of commission. At present we have not received that commission. That's why dues are created or increased by rupees 2,500. Okay, so 2,500, that is a receivable amount of commission. At present we have not received. Okay, so dues, that is one kind of asset or receivable. Okay, so 2,500, total of the assets that would come to 1,09,500. In case of capital, that is 1,07,000 from the previous balance. Now due to outstanding commission, that commission is an income, so in future we will receive that income, so it will ultimately raise the amount of capital. So 1,07,000 plus 2,500, the balance of capital that would come to 1,09,500, and liability would be as it is, nil, no any change in liability. Okay, so we have divided the 12th transaction into two parts, one that we had received in cash and the other that is outstanding commission. Now moving on to 13th transaction. Rent paid in cash 4,000 and 1,500 are outstanding. Now this transaction I have given the combined journal entry and given the effect of it also combined. Now you can see rent, one is outstanding and one is paid in cash. Okay, so the journal entry, combined journal entry that I have given, that is rent is an expense, so rent account debit. Now total that is 4,000 plus 1,500, that would come to 5,500. Rent account debit, that would be 5,500. To cash account credit, we have received cash rent in cash, that is 4,000, and outstanding rent, that is 1,500. So the combined journal entry we can give of this transaction also, of commission also, but to explain you properly I have given it into two parts. Okay, so the combined journal entry of rent, again repeating, that is rent account debit 5,500, to cash account credit, that is 4,000, to outstanding rent account credit, that is 1,500. Now what would be the effect of these three of this combined journal entry? First one, rent due to rent payment, capital will decrease because it is an expense. We already discussed it. Due to expense, capital will decrease, and due to income, capital will increase. Okay, so capital will decrease, cash will also decrease because 4,000 we have paid in cash, so that much amount of cash will decrease, and debts will increase because in future we have to make this much amount of payment, that is 1,500. So our debt over our liability will increase by rupees 1,500. Okay, so debt increases. Now the effect of capital, that would be in capital, cash that would be in assets, and effect of debt, that would be in liability. So all the three would be affected of this transaction, that is assets, capital and liabilities. First of all, cash, that was 69,000. From that, cash is decreased because we have made payment of rent, that is 4,000. So 69,000 minus 4,000, balance of cash, that is 65,000. In case of bank, that would be as it is 11,000, stock also as it is 27,000, and dues, all the three values that would be as it is from the previous transaction. Dues also 2,500. So now the balance of assets, that would come to 1,05,500. Now in case of capital, the previous balance, that was 1,09,500. Due to rent payment, what total of both, that is cash and outstanding rent, whatever you have paid in cash and outstanding rent, ultimately it is an expense, and due to that expense, capital will be decreased. Okay, so 5,500, remaining amount, that would be 1,04,000. And in case of capital, previously the balance was 0. Now due to debt increases by rupees 1,500, because that is outstanding rent, in future that would be our liability to pay that rent. Okay, so liability is increased by rupees 1,500. So up till now we have completed 30th transaction. Now moving on to 14th transaction. Goods donated rupees 2,000. We have donated the goods. So donation is one kind of expense. So entry would come, that is donation account debit to purchase account credit. Already students have explained that due to donation, charity, or goods destroyed by fire, or goods given as advertisement purpose, then any of the cases, always purchase account will be credited. So the journal entry, donation account debit, that is 2,000, to purchase account credit, that is 2,000. Now due to donation, that is an expense, so capital will decrease, and the other one, due to donation we have given goods in donation, so stock will also reduce, so stock will decrease. So one effect that would be in stock, that is in the assets, and the other effect that would be in capital. Okay, so you can see cash balance, that was 65,000, so as it is balance of cash, that is 65,000. Bank balance, that is 11,000, so as it is bank balance 11,000. Stock value, previously it was 27,000. Now stock is decreased by rupees 2,000 because we have given 2,000 worth of goods as donation. So 27,000 minus 2,000, remaining balance of stock, that would be 25,000. And dues also as it is from the previous transaction, that is 2,500. So now the new balance of assets that would come, that is 1,03,500. Now in case of capital, the balance that was 1,04,000. Now donation is one kind of expense. So due to expense, we have to deduct from the capital, that much amount of balance of capital will be reduced. So 1,04,000 minus 2,000, remaining balance of capital, that would be 1,02,000. In case of debts, no any change, so as it is 1,500. So students, we have completed 14th transaction. Now moving on to 15th transaction. Furniture of rupees 15,000 purchased from Preksha Furniture Mart. We have purchased the furniture from Preksha Furniture Mart. So the name of the shop has been given to you, so it is a credit transaction. It is our liability will be raised by that much amount. In future we have to pay that much amount to Preksha Furniture Mart. Okay, so the journal entry that would come, assets comes in, so furniture account debit, that is 15,000, to Preksha Furniture Mart account credit, because Furniture Mart is giver of the furniture, so credit the giver. So to Preksha Furniture Mart account credit, that would be 15,000. Now what would be the effect of it? Furniture will come in the business, so assets will increase. and debts will also increase because in future that much amount we have to pay to Preksha Furniture Mart. Okay, so one effect that would come in assets and the another effect that would come in the liability. Okay, so you can see in the assets the total of the balance of the previous transaction that would be as it is, that is 1,03,500. Now students, I am not written over here each and every detail of all the assets, only just I have added the new asset that is furniture. So 1,03,500 plus furniture, that is also one of the fixed assets. So 1,03,500 plus 15,000, total balance of assets that would come to 1,18,500. Now in case of capital there would be no any change, so as it is from the previous transaction, that is 1,02,000. And in case of debts, that is liability, previously it was balance that was 1,500. Now we have to pay, liabilities raised because we have to pay the amount that is to Preksha Furniture Mart worth rupees 15,000. So liability is raised by rupees 15,000. So 1,500 plus 15,000, total liability that would become 16,500. So students, up till now we have completed 15th transaction. Now moving on to 16th transaction. College fees of daughter paid rupees 6,000. College fees of daughter. So it is one kind of any of the expense that is made for personal use, that is called drawings. So the entry that would be drawings account debit to cash account credit, that is rupees 6,000. Okay, so due to drawings the capital will be reduced by that much amount. So the effect you can see, that is capital will decrease, and due to payment of college fees in cash, so cash will also decrease. Okay, so first you can see the cash will decrease, so that would come in assets, and the second one, that is capital decrease, so that would be effect in the capital. Okay, so cash balance in previous transaction that was 65,000, out of that 6,000 reduction due to drawings, so balance of cash that would come to 59,000, bank balance as it is 11,000, stock that would come 25,000 as it is, dues also as it is 2,500, and furniture from the last transaction that would be 15,000. All other assets would be as it is from the previous transaction, only there would be effect or change in the cash. Now there are new balance of assets that would come to 1,12,500. Now in case of capital, the previous balance that was 1,02,000. Due to drawings, the capital has been reduced by rupees 6,000. So now the balance of capital that would come to 96,000. In case of liability, as it is from the previous transaction, that is 16,500. Now after completing 16th transaction, let us see 17th one. Rupees 500 bank is credited for interest and debited rupees 200 for bank charges. Now 500, that is bank charges that are credited, bank credited interest, and rupees 200 that are bank charges. So one, it is an income from the bank, another is an expense, that is interest paid to the bank. Okay, so we have to give two different entries for this particular transaction. One, that is for bank interest. Bank interest is an income, so our bank balance will be increased by that much amount of interest, that is 500. So our bank account will be receiver of rupees 500. So the journal entry that would come, that is bank account debit, that is 500, to bank interest account credit, that is 500. So due to bank interest, bank balance will be increased by rupees 500, and due to income, that is bank interest, capital will also increase. Okay, so one effect of bank balance that would come in the assets, and the other effect that would come in the capital as income of bank interest. Now cash balance as it is from the previous transaction, that is 59,000. Students, you don't forget to carry forward each and every assets from the previous transaction. Okay. Then afterwards, bank balance that was 11,000, due to bank interest 500, bank balance has been increased. So now the bank balance that would come to 11,500. Stock, dues, furniture as it is from the previous transaction, that is 25,000, 2,500 and 15,000. So now the balance of assets that would come to 1,13,000. In case of capital, previous balance that was 96,000 plus bank interest, that is an income. Income will always be added in the capital. So capital will be raised by rupees 500. So now the balance of capital that would come to 96,500. And for liability as it is, that is 16,500. Now we have to look for the second part of this transaction, that is bank interest. Bank charges. Bank charges is one kind of expense for the firm. So expense will always be debited, and that much amount of bank balance will be reduced while we are paying the bank charges. Okay. So the journal entry that would come, that is bank charges account debit, that is 200, to bank account credit, that is 200. So bank charges is one kind of expense. So due to expense, capital will decrease, And the second one, that is bank balance, will also decrease because that much amount of bank interest or bank charges will be paid from our bank account, so our bank balance will be reduced by that much amount. Okay, so one effect that would be in capital and the other effect that would be in bank balance. So you can see bank balance that was previously 11,500 minus 200, that is bank charges. So now the balance of bank balance, that is 11,300. For cash, stock, dues and furniture, as it is from the previous transaction, that is 59,000, 25, 2,500 and 15,000. So now the balance of assets that would come to 1,12,800. In case of capital, the previous balance that was 96,500. Now due to bank charges, it is one kind of an expense. So due to this expense, the capital will be reduced. So by 200, the capital will be reduced. So now the balance of capital, that would be 96,300. And in case of liability, would remain as it is, that is 16,500. Okay, now after completing the 17 transaction, one for bank charges, one for bank interest and another for bank charges. Now moving on to 18th transaction. Rupees 2,500 received in advance for interest. Now this amount has been received in advance. At that particular time, we don't have to receive that interest, but in advance we have received that amount of interest. It means income received in advance. Okay, so what would be the journal entry for it? That is, cash is received in advance, so cash account debit, that would be 2,500 to pre-received interest. You can write here interest received in advance also. Okay, so to cash account debit, that is 2,500, to pre-received interest account credit, that is 2,500. Now cash is received, so cash balance will increase, and the second one, that is debt, will also increase because pre-received interest, that is one of the debt that in future will not receive that amount. So at present we have received the income in advance, so debt will increase. Okay, so one effect that would be in the assets because cash will increase, and the other effect, that is debt increases, so second effect that would be in the liabilities. Okay, so cash balance previously it was 59,000, and 59,000 plus 2,500 cash is received for pre-received interest. So now the cash balance that would come to 61,500. Bank, stock, dues and furniture, as it is from the previous transaction, that is 11,300, 25,000, 2,500 and 15,000. So now the balance of assets that would come to 1,15,300. Now in case of capital also there is no any change, so as it is from the previous transaction, that is 96,300. In case of liability, previously the balance that was 16,500. Now due to income received in advance, so our debt would increase by rupees 2,500. So now the total liability, that would be 19,000, including the income received in advance. Okay, so we have completed 18th transaction. Now moving on to last transaction, that is 19th transaction. Advertisement expense paid in advance, that is rupees 2,000. Now advertisement expense is one kind of expense that is paid in advance, that is prepaid expenses. Expense the due date of which has not arrived, but it has been paid in advance before the due date, then it is called prepaid expense. Okay, so the journal entry that will come, that is prepaid advertisement expense account debit to cash account credit, because that amount we have paid in cash. So to cash account credit, that is rupees 2,000. Now due to prepaid advertisement expense, the dues will increase because actually that was not a due of this year, but we have paid in advance. So it becomes dues will increase by due to prepaid advertisement expense, and cash we have paid paid the payment in cash. So cash will also decrease by rupees 2,000. Okay, so one effect that would be in cash, and the second effect that would be in dues. Okay, so dues that also will be in assets. So both the effect of cash and dues, that would be in the assets. First one, that was cash balance, that in the previous transaction that was 61,500. So 61,500 minus 2,000, that would come to 59,500. Okay. Next one, that is bank, as it is 11,300, 11,300. Stock, due, stock also as it is, that is 25,000 from the previous transaction. Dues that were 2,500. Now dues that were 2,500 plus due to this prepaid advertisement, the dues has been increased. So now 2,500 plus 2,000, so the total dues that would become to 4,500. And furniture balance as it is, that is 15,000. So the total value of assets that would come to 1,15,300. Now in case of capital and liability, no any change as it is from the previous transaction, that is 96,300 and 19,000 for liability. Now already I have discussed you that at the end of the sum you have to verify whether the total of assets is coming equal to the total of capital and liabilities. Here you can see the total of assets, that is coming 1,15,300, and the total of capital and liabilities, you do the total of this two, that is 96,300 plus 19,000, then the total will be coming, that is 1,15,300. So our answer is correct. So that was the end of this sum, that is exercise question number 2. That's all for today, students. Do revise the sum from the video lecture. Till then, goodbye. Keep practicing. Stay blessed.